All right, welcome to the NZ Everyday Investor. Today I'm delighted to be in the studio with Martin Hawes. How are you, Martin?
Yeah, hi. Well, thanks, Darcy.
Fantastic. Now, normally I love giving disclosures around how this is not financial advice, but I'm going to pass the baton on to you, Martin. You're a pro at this, so go ahead and give us your best "this is not financial advice" disclosure.
Yeah, hi there, everyone. And just before I launch into it, let me say that the things I'm going to be talking about should not be construed as financial advice. Financial advice should be targeted, and it requires me to sit down with people to figure out what their position is now, what they want to do in the future, and then agree a path for doing that, and then to understand a lot about people. So I'm talking generally here, and the things that I'm going to be talking about will be suitable probably for most people, but not for everyone. So you've got to do your due diligence and make sure that the things that I am talking about today are suitable for you, because they might not necessarily be. And a couple of disclosures. First of all, I'm a director and a small shareholder of Lifetime Income. And the second thing is that I also have a role with Summer KiwiSaver. Summer KiwiSaver is Forsyth Barr's KiwiSaver offer. I write articles for them and also do some seminars.
Now, you are, in my view anyway, probably one of New Zealand's most well-known financial advisors. You've always been there for as long as I've been living in New Zealand anyway, and you're very much active with your work, but these days it's more with, I think you authored up to 23 books now. Is that correct?
Yes, yeah, that's right. I started in 87. So it goes back a long way. So this is not 23 books over the last couple of years or anything.
You feel like most of what you put out there is fairly timeless and
Yeah,
still relevant for
yes,
most
I
readers?
do. I look at some of my old stuff. You go back to the early 90s or something, and you think, my God, especially, did a book on property in 95, and you look at the numbers on that, and they're pretty silly. But if you add a zero to the end of them, the stuff still makes sense.
That's right. Yeah, just add a zero. I think the book that you're referring to in the mid 90s, Property Investment, A Strategy for Building Wealth, or something like that, I
Yes,
think is
that's
what it
right.
was. I still
Yep.
have that book. It's not a massive book. It's
No.
really super easy to read. Highly recommend it. I read it in
Yep.
university as part of I think it was actually part of one of the papers I was studying. Really,
Yes.
really easy to read. So if anybody is looking just to get into more nuts and bolts, but you don't want to be bombarded with a lot of empty words, your books are amazing. Totally recommend it. How have you found the latest book? Has it been received very well?
It has. It's gone really well. It only came out, I think, 3 weeks or something, 3 weeks ago. It's already number 4 on the bestseller list, and it's called Cracking Open the Nest Egg. So it's aimed at retirees who have built a nest egg, who have accumulated some wealth, and now they're having to use that wealth to generate an income in retirement. And I think the title is a good one. I never came up with the title. I'm not very good with titles. It was the publishers who decided on the title. But I think the title's right and the timing is right. Lots of people are retiring at the moment, lots of baby boomers retiring. And of course, interest rates are so low.
And I love how whenever you see people launching their new book, they usually always say something like, "Oh, you've said it as well here. Available from leading bookshops, or where all good books are available." So it kind of implies that if you don't sell this book, you're not very good. But I know what you mean. So good effort. I haven't read it yet, but it's definitely on my list. Now, what I'd like to do with you, Martin, I've been really keen to catch up with you for quite some time. I've caught up with a lot of the other people that you know quite well, Liz Coe.
Yes.
I've caught up with
Yep.
Ralph Stewart as well. And one of the things that I really kind of resonate with you, I guess, a little bit on is the fact that your model of how you delivered financial advice when you were a practicing advisor and when you actually were meeting people is not too dissimilar to what I do. Based on that, obviously, your experience in how you work gives you a lot of inspiration for some of these books. So it's not theoretical, it's actually grounded in actual eyeballs directly and coming up with these concepts probably in front of people, I'm guessing. Would that be right?
Yeah, yes, it is. I'd be talking to people. I mean, I start this latest book with what I call a farming couple who sold the farm and looked at their bank account the next month after it had been sold, and it had $7.6 million and some cents in the bank account. And their emotion wasn't joy, their emotion was actually fear. what the bloody hell are we going to do with this? How can we keep this safe? How can we stop ourselves from losing this? And that they weren't farmers. It wasn't even a couple, it was an individual. And so their identity is well and truly hidden. But most of the examples I use, I bury the individual who wouldn't even recognize him or herself in a whole bunch of misleading stuff. But the actual story itself is true. And it was one of the things that really inspired me to write this book, was because if somebody can have a mortgage-free house and $7.6 million in retirement and be scared and wonder what the hell do they do with it, if somebody can have that amount of money, what about somebody who's got a mortgage-free house and $300,000? So just about everything I've written about, from trusts through to mortgages, through shares, through to this retirement book, a book I wrote called 20 Good Summers, just about everything, I'd had personal experience with.
Yeah, really, really important. The whole personal experience. When you
Yeah.
combine that with being a financial advisor, and understandably, there's probably some formal training and education that you would have over the years. That
Yeah.
makes a very extremely powerful combination. But what I'd love to do, I know that there's a lot of people listening and watching who might be vaguely familiar with how financial advisors work, but that these days there's one name, financial advisor, but there's many, many functions. People possibly don't realize that there is quite a lot of nuance here, and there's a lot of differences. So for the benefit of our audience, do you want to explain how you used to work as a financial advisor, what your revenue model was, and how you used to
Yes.
operate?
Yeah, sure. I'm glad you used the past tense, because I don't see individuals anymore for financial advice. I stopped doing that a year or two ago. My model was basically pretty simple. I charged a lump sum that got people a visit from me. Didn't matter where they were in the country. I would come and see them. We'd sit down and we'd spend 2 or 3, maybe even 4 hours figuring out where they were now, where they wanted to be at some point in the future, and how to bridge that gap. And all I was doing was giving advice. So my model, I charged a lump sum, and it varied over my career between $4,000 and $6,000, and that got them this session. It got their plan in writing, and then it got 12 months of help in the implementation of the plan. But I didn't implement the plan. Most financial advisors are basically looking for people who have got an insurance need, or maybe they've got a lump sum of cash they want to invest. And most of them take that cash, they invest it on the people's behalf, and charge a fee for that, usually a percentage of the amount of money that the people have. I was just charging a lump sum. And if these people needed to invest, and a lot of them did, I would help them find somebody who would be suitable for them. And Darcy, this is very like medicine. My dad was a doctor, and so I sort of modeled my practice on medicine. And back in the 1820s, in medicine, the advice or prescription and the dispensing were separated. So today, or from about that time, and still today, a doctor gives you advice. He or she writes the prescription, and you then take that prescription along to a chemist, a pharmacy, and get that prescription filled. So the doctor, him or herself, can't sell you a medication. So what I tried to do with my practice was separate the advice from the implementation of the investment. And people would come to me, they would get advice, I'd help them find somebody who would do the investing for them. And that somebody would generally follow the plan, the advice that I've given them in terms of asset allocation and the type of investments that they needed to make. It's a unusual model, and I'm delighted to find somebody who's doing it as well, Darcy. But it is a difficult model. It probably means you don't make as much money as you could. And there's very little passive income. You're effectively just selling time, like a lawyer or an accountant or even doctors. But it does mean that the advice I'm given is completely disinterested. And I would say to clients, look, I don't mind what you do. here's my advice to you. You follow it or don't follow it. I'm not interested in that, because, and that's interested in the financial sense. I'm not interested in it because it doesn't matter to what you've already paid me, or you're about to pay me, and we've agreed the amount. If you do something or don't do something, I still get the same amount of money. So my advice is completely unbiased, like yours, I suspect.
Yeah, that's right. And like I'm a little bit different because I do a little bit of implementation. So there is that, but I kind of take the view that all financial advice should be separate from implementation, at least initially, and any other advice which is connected to the implementation, then that's just the advice that you get in the process of getting something implemented. So I'm a little bit kind of open-minded, I guess, with any advisor and their models, because I understand that some people just don't have that budget, right? Like,
Yeah.
even though you were probably charging a fee, which maybe back then seemed like quite a decent fee, perhaps, when you consider the amount of time and the expertise that you have, relatively speaking, you probably weren't getting paid a huge amount. And I know that even some of the people who could have benefited from you maybe couldn't have afforded that. And so for that reason, I think there's always going to be a space, right, for those that do receive a fee from the implementation of a product, because it does mean that more people get advice. And I think the regulation kind of seems to be focused on that. Actually, on the topic of regulation, Martin, do you feel like the regulation is kind of almost these days, from what you're aware of it, is it too focused on the advice attached to implementing financial products and services? And does it kind of forget people like you and me that often charge fees or used to charge fees there?
It's funny you should say that, Darcy, because this afternoon I was working through the relicensing that I may have to do, because I've still got my license and I may or may not continue to have that. But as I was working through the Act and the regulations and getting some advice from various people, it's quite clear that because the vast majority of financial advisors are implementing, that is, they're placing the investments, or they are placing your insurance needs, or they are arranging the mortgage for you. Because the vast majority are doing that, the regulations are written for that, and I keep reading them and reading them again, trying to think, where the hell do I fit in this lot? And you'll be the same.
Oh, yeah.
I'm quite
Yeah.
sure. I'm not knocking the people who place the investments, place the insurance or mortgages. I'm not knocking that at all. A lot of them do a very useful job, and the regulations now, especially compared to 10 years ago when there were no regulations, but the regulations now are very strict. And the FMA oversees and supervises those regulations really strictly. And I'm not saying it wouldn't be impossible, because there are bad eggs in every industry and every profession, but the vast majority of financial advisors, from what I can see, are decent, competent people doing the very best that they can. And
Yeah.
it's a bloody hard thing to do, because you come along with $1 million to a financial advisor and say, could you invest that on my behalf, or tell me how I should be investing it? That requires you to have a look at the future. And I used to say to people, look, I don't have a crystal ball. And then somebody heard me say that once too often, and she went out and bought me a crystal ball. So that got rid of that excuse. But we're asked to predict the future, because that's what you are making an investment for the future. You're not doing it for the past. And really, the best we can do to predict the future is to have a look and see what happened in the past. And the past tells you what the long-term future is going to be. So I could tell you with reasonable certainty that over the next 20 years, shares will produce about 10% per annum return. But I can't tell you what's going to happen tomorrow. And I can't tell you what's going to happen. So I can't tell you in the short term, but I can with some certainty tell you in the long term. And of course, in the short term, it may be way down or it may be up. And people have got to tolerate that volatility, those ups and downs, while they're waiting for that 20-year period of good returns.
Yeah.
It's a really hard thing to do, be a soothsayer.
You do. And it's just this, it kind of makes you feel, I guess, at times that you clearly know that you're on this line, this linear line where the past is behind us. We're today in the present. We're looking forward to the future. That's a whole host of challenges when you're trying to give people advice, like you say, and you're drawing from the past, but you're helping people make decisions today, which impacts
Yeah.
the future.
Yes,
So
that's right.
on that, what I wanted to do with you now is just have a general discussion around investing, like how do we invest before our retirement? Obviously, it's not going to be that exhaustive, but we're going to have a general discussion around how do we invest before retirement, and then how do we invest during retirement? Because guess what, you can actually keep investing in retirement. So,
Yes.
starting with that first one, how do we invest before retirement? Let's just talk about some of the tools in the toolbox, and maybe start with property in particular. And knowing that you've been doing this for quite some time, can you share with me sort of any perspectives around investing in property, or some of the things that maybe property investors of today have to deal with today that they didn't have to deal with before?
Yeah, yeah. I'm a property guy from way back. I really like property. I tend more towards commercial property than residential, but I've got an open enough mind to know that both have done very well for some people. I do see property much more as a business than an investment. With an investment, we have the idea that you put your money into it and you sit back and you wait for the returns. But actually, the best property investors are very active and they run it like a business. Over the last probably decade, I've been less keen on property as the prices have gone up, and because prices have been very high, the returns to me haven't looked like they'll be there now. They've still been going up a lot in the last year, not in the last 6 months, but up until 6 months ago, property was performing really well, but it was off a very high base. And of course, the higher that a market gets, the harder it is to see future growth. And so, because prices were very high, I became less keen on residential property in particular. So, that would be my first comment, that my first thing to be wary about property. But the second thing is that housing is a public policy issue. Politicians are interested in it because the public is interested in it. And we've seen that particularly over the last 5 years, as we've had bright lines introduced and levels of borrowing that have been allowed and that sort of thing. But now, we've had the bright line extended. We've had, and really importantly, we've had the making of interest non-deductible. I did predict this about a decade ago. It's been a long time coming, but I think we're starting to see it now that governments of whichever colour are pretty serious about keeping down the value of housing. And to do that, they've in particular hit residential property investors. And I don't think that's likely to go away. I think politically, people would be happy to see their children, their grandchildren, be able to buy a house to live in at the expense of somebody who's investing in property as a rental.
That's interesting. So you kind of saw this happening about a decade ago, and I guess with the increasing politicization of the whole thing, that's obviously a bit of a red flag. Do you kind of think that a lot of investors of today are mindful of maybe the changing landscapes, or are they even cognizant of the concentration risk that they have with property?
I don't think so. I think the problem with property is it does concentrate wealth into just one asset class. In fact, usually into just one asset. And in doing that, it takes people's focus off and takes their money away so that they can't invest in some of these other things. And, there's a whole world of good investments out there. And although property has been very kind to people who've been in it over the last 30, 40 years, really, that political thing, I think, is welling up. Now, I did a book on property in 95 or 96. And in that, even I talk about residential property and politics. Really, to come back to your question, I don't think people are cognizant enough of the risks with property. people will just say, well, it's never crashed in New Zealand. Well, it hasn't in a major market, but it certainly has elsewhere in the world. And there's never been a time when, over a decade when it hasn't done well. Well, that's certainly true over the last 40 or 50 years, but it's not necessarily true if you go way back. The thing I think that I most get bothered about property is the other opportunities that people are missing. So we did a bit of work, Darcy, the other day on Amazon. Now, Amazon was listed 24 years ago, and it was listed at $18 per share. And it's since had 3 share splits. So the effective price of one share was $1.50. The price today, it's about 3,200. And if you run that as an investment return over 24 years, if you had owned Amazon all the way through, you get a return of 37% per annum.
Phenomenal.
And I mean, we're all out there looking for the next Amazon, and we're probably not going to find that. But if you look at the world as it is at the moment and scan the entire world for investment opportunities, you've got to say that technology in all its different forms, whether it's clean tech, for climate change, or biotech, those technology things are just burgeoning at the moment. And although technology is being hit at the moment, and share prices for your Amazons and your Googles and your Apples and so forth are down at the moment, I think over the next decade, if you invested in technology, I think you'd be very glad that you did.
And just keep going on that shares thing, because I want to also just pick your brains. We talk about property now in terms of one of the other tools, investing in individual shares. A lot of our audience might be self-directed DIY investors. They might have a small portfolio of a selection of individual shares. And then there's another group of people that maybe have started investing since the beginning of the pandemic, and they might be kind of just riding this wave of whatever the next hot tip is, which isn't a new concept. We've seen this before. In the context of volatility, do you think that many of these self-directed investors are, I guess, potentially at risk of not really appreciating how they will respond when they see the other side of volatility, when markets pull back by a decent amount?
Yes. If there is a major slump or a crash, really. I've lived through 4 crashes. The first one was back in 1987, and that was the biggest one of them. The New Zealand share market in 1987 peaked at 3,900. That was the index. That was the average. And it bottomed out at 1,400. So people lost basically near enough to 2/3 of their money. That was over a 4 or 5 year period. And so many people who were caught in that just said, I will never invest in shares again. And they walked away from it. And just about every family still got an uncle or a grandfather or a grandmother or somebody who will say, don't you buy those, don't you buy those shares. They'll send you broke if you buy shares. You've got to come back to basics and say, so when you buy shares, what are you actually buying? And this is one of my worries with the people going who are self-directed, going into Sharesies or Hatch or those kind of things. And they're buying meme shares, the ones that are going up and that everybody's talking about. But really, when you're buying shares, all you're doing is buying a little bit of a business. That is, if you want to buy a bit of Apple, you can't afford is it $1 trillion Apple would be worth today. So I can afford to buy a little sliver of it. And I don't think that's no bad thing. I'd rather own a little sliver of something like an Amazon or an Apple or an EBOS group, if you want to start coming to New Zealand, or a Ryman Healthcare or something like that. I'd rather buy a little sliver of something that was really good than own all of something that was a bit ordinary. And that's the case also with commercial property. I think the same with that. So I don't own commercial property directly. I haven't gone out recently and bought a warehouse or bought an office building or something. And most of them, and if I did, I'd be buying something really ordinary, something down the back of nowhere, and that was needed a bit of maintenance and had a rumpy old tenant on a very short-term lease, that sort of thing. So instead of buying something ordinary, I'm being kind calling it ordinary, it's worse than ordinary, I'd rather own a little part of a property company that's listed on the share market. So like I'm thinking of a Kiwi Income or a Goodman Property Trust or a Precinct Property Trust or Vital Healthcare or one of these ones. And they own huge, big portfolios of commercial property. And you don't own all of it, regrettably. Instead, you own a little sliver of it. So you have an exposure to A grade and premium grade buildings rather than something which is a B, a C, or a D grade building.
Yeah, I got it. So a big fan of the listed property, that route of commercial property rather than going direct
Yeah.
for obvious reasons, concentration risk, but also a little slice of something really good is so much better than 100% of something
Yeah.
that's a bit average. Is kind of what
Yeah.
you're saying,
Yeah.
right?
Yeah.
That's
And you've
cool.
got liquidity as well, Darcy.
True.
So,
Yeah.
if you look at these property companies, they're listed on the share market, so you can buy them and sell them very cheaply and very quickly. Whereas if you owned a warehouse down the back of, I'm in Christchurch, but down the back of Bromley or somewhere, if you owned that, you need to cash up. You can put it on the market and you might sell it in a couple of months, but you might also wait 6 months or a year or God knows how long.
That's right. And that's what's so cool about, I guess, commercial property in particular, because commercial property is kind of a gateway drug to get residential property investors away from just that class. And then when you get into commercial property funds, it's another gateway drug to get commercial property investors into the share market, really, because once they see that they can have the same benefit, but through a different avenue, then they've got all the other benefits that investing in shares give you, like liquidity, the ability to rebalance, diversification, all that sort of fun stuff. So now I want to just kind of quickly shift gears, if I can, Martin, to talk about something that's a little bit new-ish. What are your views on cryptocurrencies and NFTs? Do you have anything that you'd want to share on that one?
Not really. I'm wary of them both. For me, the definition. I go back to some of the old masters like Benjamin Graham in the 1940s, and of course Warren Buffett, who's still around and still very active today. Maynard Keynes, and they defined an investment as something which gave you an income, so that you could bank that income and your investment wasn't dependent on a price movement. So if you think of gold, for example, if you bought a bar of gold, the only way you can make money is that it goes up in value. There's no income coming off it. And really, when you boil it down, there's only three investments you can make. You can invest in business via the share market. You can invest, and you've got an income in terms of dividends. You can invest in property. You've got an income, the rent's coming through, and you could invest in interest-bearing deposits of all sorts, and you get paid interest. So they're the only investments that you can make. Whereas with a crypto or a non-fungible token, an NFT, you're buying those in the hope that somebody else will come along and buy it off you at a higher price. And that's not investing, according to Ben Graham and Maynard Keynes. That's actually speculating. So I'd be very, very wary of those things. Okay, for people who perhaps know a lot about them, maybe, and studied them and so forth, but it's not for me.
Yeah, no, fair enough. Stick to what you know, right? If nothing
Yeah.
else. So let's talk about, because we've kind of covered some of the tools. Like there's quite a few tools, and there's quite a lot to that. But in the interest of time, we're going to move on from, hey, how do we build wealth in preparation for retirement? And now let's flip the switch and talk about how do we invest in retirement? Because
Yeah.
this is one of those weird things where I think a lot of people are really good sometimes at accumulating wealth. But when they get to that, I guess that apex where they're ready to kind of start going downhill, they kind of feel like maybe they're turning their back on the very principles that got them there. So it feels so unnatural. Did you kind of find this when you were advising clients directly? Did you kind of find that it was a little bit, almost felt like a dirty word, mentioning decumulation and spending capital?
Yes. This book that's just come out, this is, it's about decumulating. And, I make the point there that, we build up wealth, and there's plenty in the literature about building up wealth, but there's virtually nothing about what do we do with that money to get an income, so that we're using it for the purpose that it was intended. And people get frightened into doing some things which aren't the best things to do. So, some people who perhaps have a bit more money than others might say, well, I'm just going to buy a rental property and live on the rent. Well, again, you've concentrated your wealth to just one thing, and you've missed out on other opportunities. And of course, it's not divisible. You can't sell a little bit of a property. The biggest, I think, well, a couple of things, I suppose. The hardest thing in all of finance is actually to take a lump sum of capital and to invest it so that you've got a reasonably steady income for yourself in retirement. That's actually very difficult, and there's not a lot of help with it. The really big change that I've seen over my career is people's, and I don't know, Darcy, whether you're seeing this, but is the people's preparedness. They're prepared now to spend not just the returns they get for their capital to fund their retirement, but to start drawing out some of the capital as
Yeah.
well. Can, if you want, let the check to the undertaker bounce, because you build some capital up and you start spending the investment returns and the investment capital gradually, and it gets worse and worse. And if you get the timing perfectly right, the check to the undertaker would bounce and you go out on the last dollar. And, when I'd say that 20 years ago, people would sort of they'd chuckle a little bit maybe, and she would maybe give him a dig in the ribs or something like that. But they weren't really prepared to do it, whereas now people are. And I think a couple of things have happened. That interest rates are so low, meaning that investment returns tend to be a bit lower. They won't necessarily be lower with shares, but they certainly are on that interest rate side. And our life expectancy's expanded, so we live longer, and therefore, to take an amount of capital and fund a decent retirement from that, you actually have to spend some of the capital rather than just the investment returns.
That's probably one of the biggest things that really still strikes me with when I'm dealing with people is this. I don't want to belittle it by calling it a notion. I just can't think of a better word, but this notion that investing is all about building passive income and preserving the capital so that you can pass the capital on to somebody else. It's great if you can, but like what you just said right there, with the general decline of interest rates over time and the general falling rates of return, it's inevitable that we have to start consuming the capital, for most of us anyway.
Yeah.
And why wouldn't you want to anyway? Because your money has to be spent. And I think I was the conversation with Liz Coe that I had around this, and she kind of really hammered this home to me, which was, hey, somebody has to spend your money at some stage. Right now, you can actually design who that is. Who are you going to choose? So I think if you can spend your money on purpose that you've worked so hard to build up, why not, right? Like that's kind
Yeah.
of the name of the game.
Yep. I
Sounds
think we
cool.
all want to leave a little something for the kids. I don't think we have to leave everything that we've accumulated, the house, our investment capital, whatever else that we've got. I philosophically, I don't believe that we have to leave all of that to the children untouched. It is your money. You've accumulated this. I had 2 or 3 clients who had inheritances that they had received, and they wanted to pass them on to the children intact. And I could understand that. That's reasonable. And ultimately, I don't mind what people do. Whatever they want, that's fine. But it's just that for the vast majority of people to fund any sort of decent retirement now, you simply have to tap into the capital as well as the investment returns.
Yeah, well said. Okay, so now let's just visualize a retired couple, let's say, or somebody who's just a little bit pre-retirement, and they're maybe they haven't done the best job in accumulation, and maybe they did decide that paying off their mortgage at the expense of any other investment activity was their sole target. That was their one objective. And as a result, their KiwiSaver balance isn't that significant. Yes, there's government super, but there's a shortfall. I want to ask your opinion on reverse mortgages. And I think, yes, it is a little bit scary taking out a mortgage when you've just hopefully become mortgage free, going back there again. But in the new world that we're heading into, when there's so much equity locked up into our home, we have to consider all the options on the table. What are your thoughts on reverse mortgages?
Yeah, I've always rather liked them. I mean, I wrote a book going way back to about 96 or 97 called Your Money Lifeline. And I talked a lot about annuities and reverse annuity mortgages, home equity releases. It's often called now. And they're much better products now than what they used to be. They're much better designed, and they mean that you can't have negative equity. That is, you can't be thrown out of the house because you've drawn all your money out of them. I've got no problem with drawing out the capital from the house to fund lifestyle. One of the things that I think that couple you were talking about need to be well aware of is a couple of things that they might want to think about. One is that they might work beyond age 65. The majority of people do. I think the average age of retirement now is about 68 or 69 years or something like that. But the other thing to bear in mind is that although when you retire, your expenditure levels will stay high. They may even stay about what they were before you were retired. But as you get into retirement, gradually your expenditure levels will drop. So the amount of income that you need reduces over the course of retirement, just because you're most fit and most active and wanting to do things at the beginning of it. As you get older, these things get harder to do.
What you said, hopefully the check to the undertaker bounces, right? But if you front load that first, especially that first third of your retirement with a lot, when you're the most active and you can enjoy yourself, then that's probably appropriate. We're never going to get it right, but hopefully we
No.
don't want a shortfall, right? Like that's the
Yeah.
ultimate. Awesome. So as we come in for a landing here, Martin, and just to kind of wrap it up, I guess we've talked about a couple of things that we can do to build up wealth. And then we've talked about some of the challenges around decumulation, on how to invest in retirement. And by the way, I think you probably agree, Martin, here that we've talked about some specific strategies. We've even mentioned some specific companies. None of this is financial advice. Please don't act on any of this. Do your own due diligence. But before we finish up, I'd just like to, I guess, climb into your world a little bit and just figure out, well, now that you are retired, whatever that means for you, actually define what retirement is for you, Martin, and just tell our audience what you're up to as an example of what it's like to be retired.
Yeah, well, I hold a gold card, so I'm over the age of retirement. I receive NZ Super, but I am still working, even though I've stopped giving financial advice one-on-one. Still working quite a considerable amount. I've got the odd not-for-profit thing that I'm involved in as well. So I don't spend all my time going off rock climbing or going off mountaineering or swimming across an ocean or something like that. I'm still gainfully employed.
That's good to hear. But you touched on something that I think is really important in terms of why we do this and why is it important that we actually are financially secure in our retirement. And that's what I would call the reason why. So you're doing some stuff, you're having fun, but you kind of touched on the fact that you're on the board of a couple of non-for-profits. How important, in your view, is having a sense of purpose in all of this, which is outside of just becoming financially secure? Like, how important is it to be living for others out there in the community?
To be honest, Darcy, I'm not able to imagine any other way. I can help people retire. I can help people with their money, so that they can have a good retirement and so forth. But I just cannot imagine stopping completely, waking up one morning and not needing to look at my computer to see who's getting in touch with me and such like. Now, I guess there'll come a time, although my dad carried on practicing medicine through to a year or two, less than a year before he died. And I suppose I'm working off his model. I am fortunate that I've done my work sitting on my bum. I haven't been out doing hard manual work and so forth. And I know there'll be a lot of people watching this who will be longing to retire. But I enjoy what I'm doing, and I'm just going to keep on doing it while I'm still okay at what I do, and while I can be helpful.
Yeah, no, that's really cool. And what's going to be the next book, Martin?
Oh, I don't know. I think I've written a book on shares, and I think I'd like to write a book on shares, which was relevant to the people who are joining Sharesies and joining Hatch and these other kind of platforms, and they're joining them in droves. And I think that's a really good thing, Darcy. I'm delighted that people are learning about investment by doing it, and that's the best way of learning. You learn by doing more than just about anything else. I hope that there's not a big crash and that these people become disgruntled, decide to wash their hands of it, and I do hope they make money. But I think I could give them a lot of advice from a perspective of 40 odd years and having lived through and invested through 4 major crashes.
That would be an interesting title for a book right there. 4 major
Yeah.
crashes and how to survive them all. Look at that.
Not bad, actually.
That's cool. Okay, well, I've just put on the screen for those that are watching the website for those that want to find out more about what you're up to right now, martinhawes.com. And really wanted to thank you. They say you should never really meet your heroes, but I did, and it seemed to work out fine. So thanks very much, Martin, for your time, and thanks for all the work that you've done for New Zealanders building wealth for decades. So thanks again.
Well, thank you, Darcy. Thanks for the opportunity.
No worries. All right, take care.